Okay, I'm going to do a overview of some of the important points from Chapter 9. This is a chapter on health and disability income insurance. This is probably the chapter that is in the need of the most revision in the book, and that's because of the implementation of the Affordable Care Act, or what's often referred to as Obamacare. Greatly changes at least the government health care provisions discussed in this chapter. I'm sure the next revision will have a much larger discussion of that. So that's one thing that's somewhat deficient in this current version of the book. In the last chapter, we talked about automobile and home insurance, and we talked about purchasing insurance as a way to protect yourself from certain risk outcomes that can have a significant effect on your financial well-being. And that's certainly the case with respect to health insurance. Most of you are in your early 20s in this class, and I think it's safe to say that most of you have not incurred major health expenses. But even something like had you broken your leg or hurt your knee skiing or playing soccer or something, the large expenses associated with even relatively minor injuries now can certainly put you into bankruptcy. So health insurance is an extremely important thing to have. The broad-term health insurance, in the chapter, they discuss two big issues. I'm mostly going to focus on the first part, which is medical expense insurance. There's another component, which is disability insurance. Disability insurance is often offered through your employment. If it's not offered through your employment, so when you start a job, your benefits will be covered in your first or second day of orientation. Disability income insurance might be something that you consider purchasing. Health insurance, with respect to the type that most individuals have, can fall under three basic types. One's the group plans, and this is kind of more or less, not entirely, but it's a heavily defined by the U.S. experience. These are plans that are usually offered by your employer. If you have a group plan, there are group plans that are not tied to your employment, but usually they are. And so in a group health insurance plan, the employer pays part of the cost. It's funny, the book describes it as potentially pays most of the cost, as what's changing is the employer is paying a smaller and smaller fraction of your group plan health insurance cost over time. Most individuals who have insurance have group health plans, so they're offered through your employment. Then there are a set of individuals who purchase individual health insurance. So this can be insurance you purchase sometimes between employment spells. You'll purchase individual insurance, or many Americans have jobs that do not offer health insurance through the job. They do make a sufficient income. They don't qualify for the government plans, and so they have to purchase individual health insurance. It tends to be quite expensive. And the third kind of insurance is a little bit unusual, but I want to mention it because it actually is something that, until it was enacted as a requirement by the government, without it, many individuals had a health insurance hole, or a period where they didn't have insurance, and that's called COBRA. COBRA is when you've been working in some employment, and you have a group plan offered through that job, and you lose your job. COBRA is a requirement that you are allowed to continue to purchase health insurance through the group plan of your previous employer, typically for a period of another year. It can also be up to 18 months, I think. Previously, it had been when you lose your job, and it might take you 3 or 6, or in some cases even longer, months to find a job. During that period of time, you would not have insurance or be confronted with having to buy individual health insurance, which, as I had mentioned just a minute ago, is very expensive. So at a time when your income goes down, you would be confronted with spending a large amount of your income on individual health insurance. The COBRA requires companies to continue to allow you to purchase through their group plan, not indefinitely, but long enough that most people are able to find new employment before the COBRA period expires. In terms of types of health insurance, for the most part, you can think of the kind of 2 tiers. There's a basic health insurance, and then there's major medical. Okay, so right now, you can kind of think in your 20s, you might only need basic insurance, which is hospital expense. If you go in and you have something minor, you might need a minor surgery, or in particular, what you probably need is some coverage for when you see a doctor. Major medical covers more substantial healthcare outcomes where you need to spend longer periods of time due to more serious injury or longer term illness. Major medical provisions in your insurance often have deductibles, co-insurance. So these are basically, again, the kind of ability for the insurance companies to ask the individuals to help bear the cost of these bad outcomes. But there's also stop-loss provisions, which set the maximum out of pocket. Many individuals have both basic insurance and major medical. In fact, that's probably typical for most private insurance offered on a group plan. Key provisions. So when you start looking for insurance, most students are covered under their parents. In a few years, you will no longer be eligible to be covered under your parents' insurance. So things that you want to be looking for, it's very important because insurance purchasing, often it turns out to be that you don't realize that you've purchased an insurance product that doesn't satisfy what you need until it turns out you need it, which might be several years later. There's eligibility provisions. So for instance, how long do you have to be employed till you actually get onto the plan? Sometimes there's a waiting period. Assigned benefits is an important provision to have. Assigned benefits means when you go to the doctor, when the doctor seeks payment, the insurance company pays the doctor or the hospital directly rather than going through you. It's a really important provision to have. You don't want to be in the middle of where the doctor is coming to you to get the payment. You want the doctor to be able to go directly to the insurance company. An important thing when you look at your insurance offerings from your future employer is what are the limits, okay? And this is an area where people often overlook the limits and focus on only what the monthly cost of them will be. Often insurance companies have an internal limit that is for a particular healthcare issue, how much they will pay. So for instance, if you hurt your knee and you need to have, let's say, ACL surgery, there's a limit on how much they will pay for that particular bad health outcome. There's also aggregate limits, which would be you have a variety of things that have happened to you. You've had a car accident. You've broken your leg. You also have some physical therapy you need to do, etc. Sometimes there's caps on the total payment they will make on a particular event. And then there's often out-of-pocket max, which is important because different companies require you to be making deductibles and payments, co-payments, when you're having these claims. And if you have, let's say, $50,000 of medical expenses for an accident you've had, you want to be sure that the maximum amount that you have to pay is clearly specified. So 2 insurance policies one that has a lower out-of-pocket max than the other that would be more attractive. You're going to want to look at deductibles and co-payments. Okay, so when you go to the doctor, or you go to the ER, or you go to a hospital, you often have to make a co-payment. So, for instance, a very common might be a $15 or $20 copay every time you go see the doctor. There's also deductibles, which might be that you have to spend, again, $2,000 of the first $10,000 of medical coverage when you, for instance, deliver a baby. That might be, you have a certain amount you have to pay. There's service benefits. That is, you're entitled to certain specific services, and that varies from plan to plan. Some health insurance plans cover mental health provisions, some don't, or some limit what they cover. And there's benefit limits. So basically what I'm trying to stress with you is that when you're looking at a healthcare coverage, basically what you're shopping for, unlike when you purchase a car, which is you're looking for things that the car has. When you're looking for insurance, the things you're focusing on is what do they limit you having, all right? And so it's really a challenge. Usually there's a significant trade-off between the monthly cost to you out of usually a paycheck deduction versus what you're eligible for. And that trade-off is something you need to be aware of. When you choose a lower cost insurance plan through your company, what does that mean you're not going to get? In terms of private health plans, there are several general types of plans. There's private insurance companies. Many private insurance plans fall into this Blue Cross Blue Shield term, which is hospital and medical service plans. Increasingly popular are health maintenance organizations. It's a different type of plan than a traditional Blue Cross Blue Shield plan. Under health maintenance plan, usually you have a set of doctors. So the set of doctors that you can go to is limited, and often you have to go, before you can see a specialist, you have to see a regular doctor who approves you to go see a dermatologist or whatever else you need to see. So health maintenance organizations have emerged as important ways to try to limit cost. But the big thing about health maintenance organizations I would draw your attention to is that they are associated with HMOs is limited coverage, right? HMOs often limit what they offer you in an attempt to restrict the amount of cost that you're going to have to pay. And the chapter covers some of these other terms: PPOs, POSs, and employer self-funded health plans. Unless you work for a real large employer, self-funded health plans are super risky to have, because if it turns out that the employer suffers in an economic downturn, or the business just does poorly, you might think you have a healthcare plan, but if the employer hasn't funded the self-funded plan, you may not actually be able to get coverage. That's only a good option for extremely large companies. That's a real negative if you're working for a small company and they don't have an HMO plan or a PPO plan or a traditional Blue Cross Blue Shield plan. This is the section of the chapter that, in my own view, is particularly inadequate. And that's a discussion of government healthcare programs. Right now, in terms of what I would be testing you on, is largely limited to discussions of Medicare and Medicaid. And of course, again, the big change is the Affordable Care Act of 2010, or what's known as Obamacare. That will change government healthcare program offerings substantially going forward. A lot more people are going to be covered. A lot more procedures are going to be covered. That will have to wait for future editions of the book. The big difference between Medicare and Medicaid, people often get confused about the two. Okay, is Medicare is healthcare coverage for basically older individuals, age 65 and older, and individuals with certain sets of disabilities or healthcare issues. Medicaid is government insurance for low-income individuals and families. Medicare covers, in a general sense, just older people. Medicaid is covering low-income people. The other important difference between Medicare and Medicaid is Medicaid is a program that, while it's financed largely by the federal government, it's in fact administered by the states. So different states have different Medicaid policies versus Medicare is a federal policy, so it's much more consistent across states. The drawback to Medicare, in a sense that there's a drawback, is it does not cover everything. Okay, so many seniors, if their only insurance is Medicare, will find that the Medicare plan, there are certain things that it does not cover. One thing that historically was a problem, for instance, was Medicare did not cover prescription coverage. And prescriptions would be extremely expensive. That was added during George W. Bush's administration. They added prescription drug coverage under Medicare. That was an important thing. But many people who were on Medicare buy what's called Medigap insurance that goes on top of Medicare. Medigap insurance is basically insurance that covers the areas that Medicare doesn't provide service for or sufficient coverage for. That's the highlights of this chapter. The book goes in a lot more detail, and as I said, going forward, we're all going to have to learn about what Obamacare does and does not offer us.